All right, so we're basically just going to dive into three main indicators today. You might notice that the names are slightly different if you go into the indicator series, or if you go on TradingView and put them on your chart. But they're essentially the same thing. I just made like some upgrades along the way, and at some point in time I'll publish like the newer versions of them. We're looking at it's on my chart, it's the prophecy, but it should be the binary pivots with parabolic SAR. But essentially that's just a combination of like a few different key indicators. And then we have the TJD TD MACD. That one should be exactly the same. I don't think I've updated that or anything, as long as you have the settings still set to what I had them at. And then also we got the TJD Jewel Thief, which I can't remember what that one's published under. I think it's just the Jewel Thief, but it's essentially going to be the same thing as well. There's a lot of options you can change on all of them as to like what lights up, if you get the hard sells, hard buys, moving averages and stuff like that. So as long as you're using like the same settings as me, it shouldn't really be an issue. All right, so we're just gonna we'll start with the prophecy first. So I'm just gonna get rid of the other two, and we'll just look at that one. So essentially the breakdown of this indicator, there's like a bunch of different parts. Obviously starting with first off the moving averages. They're like the most important part, most basic part. And then you'll notice also we have like the red and the green dots. That's the parabolic SAR. The red's the resistance and the green is the support. And then finally we have the binary pivots, and those are the purple dots and the blue dots right here. And essentially those again are support and resistance, but just a different way to measure and calculate them. So if you go over to like the actual indicator itself and click on the settings, it'll pull up this screen right here, and you can basically just see how I have everything set up. You can see where I have the pivots at, where I have the moving averages. EMA obviously is exponential moving averages. SMA is simple moving averages. A lot of times people ask me why I use the specific ones I do. These are all Fibonacci numbers, 8, 21, 55, 89, and then 377 and 528. The 200s and the 50 are what's used like in traditional markets. So the idea of moving averages and pretty much all technical analysis is essentially trying to see the same thing that like people across the world are seeing at the same time, and then using that to make like educated guesses basically on what price is going to do, or based off of like previous trends or previous happenings, essentially the likelihood of it happening, and then what to expect when that move does play out. And if you click over to the style, you have the ability to basically like change the colors on the moving averages and stuff like that. I have them set up just because of how I like them, but like obviously using like the blue 200 exponential and 200 simple, just corresponds those two, that essentially they're telling you the same information, just slightly different, in the same way that the EMA 50 and the SMA 55 do the same thing as well. So and then I wouldn't really mess with the other stuff. I mean, you could change the colors if you really wanted to, but essentially the idea is that green and like cold colors are your like supports, and like the warm colors and dark colors are the resistances. So, and along the way, I'll take a couple like little brief breaks and see if anybody has questions after we go over like a decent amount of information, just to make sure you're not lost. So if you do have a question or whatever, rather than just like jumping right in with it, just wait, and I will give you an opportunity to ask that, because chances are if you have a question about something, somebody else probably has that same question. So does anybody have any questions so far? Having any troubles finding or using the indicators? All right, cool. We can keep going then. So basically, obviously, you have just your straight up price action on the chart, And I'm going to start with the moving averages, and we're going to talk about what the purpose of those is and how we can use them essentially to determine the trend. Moving averages are in many ways the most basic thing that you can use for successful trading. So if you've been in markets, for a while and you're not having luck or you're not doing well, moving averages are an excellent place to start. And I highly recommend that you spend time to master the moving averages, what they mean and how they correspond with each other, as well as how price corresponds based on what those moving averages do. So let's flip that back on real quick. And we're going to go ahead and turn off a little bit of the other stuff, just get like a little bit of the noise out of the way. So we'll go back to the settings again. And then we're just going to turn off the parabolic SAR. We're going to turn off the binary pivots. And then now we just have our basic moving averages here. And we can kind of go from there. So as you can see, obviously like with the 8, the red moving average, you can see how it acts as support, how the price basically bounces off of it, and essentially as it's going up, it forces the price up as well, and the price will come back down to it, but often we'll find support. So even if it breaks through it like violently like it did right here, a lot of times it'll still get picked up and it will not close below it. Now the key thing to pay attention to is once one of these candles closes below it, and then you get an open below it and a close below it, that's essentially confirmation in the market that the trend may be getting ready to change. So it's possible that you get essentially like a push down, like a wick like this, and then you still close above it and then price continues. It's possible that you get a breakdown like this and a close below it, but then price gets picked back up. But typically this candle right here is a warning sign, because what it did is it closed below it, and then this candle opened below it, and then this one actually closed below it again. But to tell you the truth, if you were watching this real time, this would not have signaled you that the trend is about to change, because actually like what happens right here is when this pushed down here before this candle printed, the next one printed, this red moving average would have been lower because it got dragged up aggressively by this next candle, so it actually would have closed lower. So this would have been a close below the red moving average, this would have been an open, but then the close would have been back above it. So in real time it's hard to tell, but I'm telling you that is how it would have looked in real time. And you do have to be very careful with people when they have like signals and they tell you like, oh yeah, because of this signal or because of this cross or because of X situation, we knew to take a short or we knew to take a long or whatever, because although these are based on candle closes and they print accordingly, the price and movements will actually change in that same way that I was just explaining. So somebody could say, oh, this was a clear indication that price was going to sell off, and then you're like, yeah, but it went up. Well, if you watch this in real time, this closed back on top of it, so it did find support one more time. But anyway, the moving average itself is going to be support when price is above it, the same way that when it broke down below it, it found the next moving average. It's going to act the same way as resistance. So now once we get underneath it, you would expect basically like the 8 to act as resistance, and then once it comes down, it would potentially find support on the 21, the next moving average, and then once it's below the 21 and the 8, you would expect them to both act as resistance. In this case, it was an attempted push back up, completed our chart pattern, the head and shoulders. Completed our chart pattern, the head and shoulders, and then we broke down from it. We immediately found support. When you break through the 8, you would expect the 21 to act as support. When you break through the 21, you would expect the 50 to act as support. The 55 and the 50, sometimes one will act like very clearly as resistance or support in the market, and the other will be less clear in the same way that the 200s correspond as well. And based on price action and what time frame you're looking at, also the longer period moving averages like the 200, the 377, and the 528 are basically going to be extremely accurate or not accurate at all. So you might look at a Bitstamp chart and it's going to tell you one thing based on the 200 and the 200 exponential end simple, and then if you look at the same chart on Coinbase, because it only goes back like a few years when you start looking at the 200s, it's not going to be able to tell you as accurately the information would on like a Bitstamp chart. So whenever you're charting like longest or longer time frames, you want to be looking at the chart that has the absolutely most amount of price data. So in this case, I like to use Bitstamp. And then I also like to have a chart active on like whatever exchange I'm trading, because you may see like slight variations on shorter time frames in like price action or where the moving averages correspond. And the last thing you want to do is try to enter or exit a trade based on the wrong chart. So you like could miss a trade by a couple dollars, miss an entry and exit a target, etc. So that's why you'll often see me charting on Bitstamp for long time frames, but then I'll be using like a Coinbase or a Kraken or one of the other charts, you know, on occasion, or you'll see that chart pop up or whatever. It's just basically because I'm trading on that exchange. So, but in this case, this is a very good example of what we're going to be paying attention to today, which is moving average crosses and how we use them to determine the trend. So we can go back here basically, and we can start. Let's start over here where we basically had a long consolidation period, but we had clear crosses. So once again, I'm going to turn off a couple of the other moving averages and just make it a little bit more clear of a picture. So this is what you really need right here. This is the most important two things. And you can use whatever period moving averages you want for your short terms. I know some people use 5, some people use 6, some people use 7, some people use 9. People use the 20, people use the 25. You can use whatever you want. It's up to you. It's what works for you. But I'm telling you that after like literally tens of thousands of hours and like decades of, you know, analysis, basically, you know, different variables, etc., that the things that I've found personally for me that work the best are the 8 and the 21. So you might see somebody else using a variation of those. You might see somebody else who discovered what, you know, I basically created here or whatever. That's fine. 8 and 21 are the best and most effective in my opinion. So what we're paying attention to is when they cross. And what that's going to cross, that's going to symbolize not that price could never go higher or lower once they cross, but it's going to be a very clear trend change. Okay, so here we have a cross. So what I'm going to do is I'm going to represent that cross itself on the daily time frame, just with a circle. So that is essentially a buy signal based on moving averages. That is telling you now that the trend has changed. We are no longer in a consolidation or downtrend. We are now in an uptrend. If you just take a hard buy right here and put a tight stop loss though, I'm not saying you'll never get taken out of a trade. What this is telling you is that for long periods of time, you can expect upward price movement, and that until you see these cross back over to the downside, you can expect a long trending trade. So based on whatever time frame you're on, that's going to change. But in this case, we got the cross to the upside at $7,250. And then if we go way over here, we'll notice that we didn't get the cross back to the downside until $9,700. Fucker. So basically, if you bought back here and you sold right here and you didn't pay attention to anything else and you did this in real time, no, you know, hindsight TA, no going back in time and saying I would have done this, I should have done that. This is a proven technique that you can use. That was a 34% move. It's a nice gain in any market, anytime. It's very consistent, it's very reliable, and it's an easy way to make money as well as determine the actual trend. Could you have sold up here and made more money? Yes. Could you have bought down here and made more money? Yes. Could you have gotten a fake out and this crossed to the upside and then went back down to the downside? Yes. But if you use just moving average crosses on the 8 and 21, and use proper position sizing and risk management, you will succeed trading markets over time. But this is for trending markets. If you look at a market that's went sideways for 20 years, this is not going to be an effective, useful tool. This is useful for markets that are either going up or down, or at least have volatility. But it is the most useful tool you will ever use. So now let's keep going. So regardless if you want to short right here or you just want to exit your position, the fact of the matter is this is a trend change. We get the cross and now we're going down. So now we can do the same exact thing again. Zoom out and we can look right here. That's where we would have got our cross back. So once again, we exited position right here. You can look at that however you want, and you can say, okay, I left right here and I flipped short on my position, so now I'm short in the market. Or you can say I left my spot position and I'm no longer long in the market, I'm just flat. So if you did that, this was a 32% move. So once again, another 32% move. So if you had $1,000 in your account when you left right here, and then you just rebought right here, you basically saved yourself $300, losing $300 of your money. So now if you take that same $1,000 and then you just put it back in the market right here, you still have $1,000, but you have a shitload more of the asset you purchased. You have 30% more of the asset you purchased than if you just held through this right here. And your $1,000 in value went down, but you had the same amount of Bitcoin. The difference is you gained asset instead of losing money, as opposed to if you did an actual short, you would gain money and you would also be able to repurchase more of that asset. So it's basically a win-win, but you don't always have to short to benefit from downside movement. And that's a common misconception that people have. They think, okay, if I didn't short the market up here, I lost out on money. No, you did not. You gained like profits or buying power. So the asset now is weaker, but your account is the same. So there's more of the asset available for a cheaper price down here. So you can now buy $1,000 worth of Bitcoin again at 6,600, and you get way more than if you had $1,000 worth of Bitcoin and it was worth 9,600. And again, that's just using these moving average crosses. Now, could you have exited your position down here? Could you have shorted here and then closed your short down here when you saw a double bottom candlestick pattern, or when you saw this double bottom right here? Of course you could. And that's just called being dynamic in the markets. But the fact of the matter is that you don't want to be trading against the predominant trend. So yes, you could be taking longs out of this area, but if you're taking a long out of this area while the trend is still downward and you're still below these moving averages, you're taking a counter trend trade, a very risky trade. So what you're hoping for is essentially a bullish retracement of a bearish dump. And what I mean by that is the same as back here. If you have, actually this isn't a good spot to show it, but essentially if you have like what's going on with us right now, we are basically in a long-term bull trend right here on this time frame, and now we've gotten a bearish retracement. We're having a bearish dump right here of the bullish trend, but the fact of the matter is that this retracement so far is still internal. It's an internal retracement of this move, which means that the low did not come and take out the low from here. And the same way that you would have, this is essentially a bearish retracement, and then this right here was a bullish retracement of the bearish trend. But as soon as it becomes larger, as soon as it breaks out above the top of this right here, this is no longer an internal retracement. So the trend has clearly flipped, obviously, to bullish, and it's no longer an internal retracement, because from the low to the high, the previous high right here to the low, and then the new high took that out. So that's obviously an external retracement. The retracement is larger than the actual move itself. In the same way that this right here would have been essentially a bullish retracement if it bounced back here of the trend. This broke down and took out that low, so now it's an external retracement. It's larger than the actual move itself. And that's the purpose of getting into these, because you want to know, are we just retracing part of this move, or are we going to continue to the downside and take out this high right here? Is this still a bullish move, but we're just in a bearish retracement of the bullish move? Or is it vice versa? Is this going to come down here, take this out, and we're going to go to lower prices back down below 3,000? So in the same way that we were using this to buy in right here, we had a couple close calls right here, and anybody that was watching the channel remembers me talking about we could get a fake out right here. We need to be very careful. And then when this one happened again, I said the exact same thing. I said we just got a fake out right here. We never got a confirmed candle close below, open below, and then close again below. And that is the absolute confirmation is a close below is good. We closed below both moving averages. So that's telling us, hang on, better pay attention. The trend might flip here. But we never got an open and a close below both moving averages and then rejection continuation, which is what we would expect to happen. And the same way that this is it. We basically break down right here. We get a close below, and then we get an open below, and then we get a big continuation candle. But then we did get the price pick back up, but that was confirmation to the market. So now here we are up here at the top of the trend. We basically got a massive continuation, retest, retest, and then here we got a close below, open below, and then it looked like we were about to get continuation, and then once again price got picked back up and we were able to save the trend. And once again, if you've been watching the channel for a while, you remember me specifically talking about this. Let's not get hasty here yet, because this could just as easily push back up and save the trend if we get back to the point of the 8 and the 21 cross. And we did, not only did we get that, we got massive move up and continuation. And basically that was us. That was basically a Wyckoff distribution pattern. We took out the high and then essentially got our move. And then you'll see right here again, we flip back over the trend and confirm. We attempt to get back up again here, but the trend does not change again. And then finally we consolidate long enough on top of it. This is almost a fake out, almost a fake out. Looks like continuation, and then boom, we get the actual move again. My bad. When I use my push to talk, sometimes it like sticks with what I was just touching before. So once again, this didn't take you out of a huge loss or a huge drawdown or whatever, but it at least de-risked you. So yeah, sometimes it's going to happen like this, where you get that massive move, and then other times it's going to happen like this, where almost nothing happens in price action. But the fact of the matter is, you don't know, is this about to happen or is this about to happen? So by de-risking, you basically are protecting your capital. You're making sure you don't lose your money on some bullshit sideways, like potential downside, potential upside, like consolidation, so that you can stay in the markets for the big moves. And again here, slight fake out, come back up, and then you remember me talking right here. Everybody was extremely bullish. Everybody was talking about confirmation. Everybody thought this was going back up to the moon. And we were the literal only people in the market talking about the head and shoulders that was obviously developing. Matter of fact, we were short through this. A couple guys in the group actually nailed the top even better than I did. But we were short from up here in massive downside. And then we flipped long again back down in here because we were back at the neckline. It was very clear what we were getting ready to do. We called this exact move happening again before it ever happened, not using magic, not using the shake of the magic 8-ball. We used actual technical analysis, chart patterns, and very, very clearly we could see what was going to happen before it did. So here we are now, basically massive move afterwards. So that tells you right there that we're not the only one watching this, okay? Because as soon as we got the confirmed candle close, we got a massive dump. I mean, this is enough to literally change your life one way or the other, okay? You either lose everything or gain everything, or even if you just get out in time that you don't eat this to the face, you could literally buy right here and say, fuck it, I don't even care if we go up or down. I just dodged like a 20% loss. I'm happy with that. Now, is that smart? I don't think so. But now you'll see we're putting in basically a flat line support right here, horizontal, and a flat line resistance right here. So we're basically range bound inside this pattern until we get the next move. So is the next move going to be a retest back up to the breakdown point? Is it going to be downside? You know, I have an idea right now, but we're not going to jump the gun now. You don't want to just rush back into a bad trade just because you made a great one, or rush into a good trade just because you made a bad one. You want to just let the market tell you what's going to happen. So here we are in a confirmed downtrend on the daily for the first time since July. So all through the end of July, August, and then into September now, here we are. We were in an uptrend that whole time. This was when you buy the dip. This was when you buy the dip. This was when you dollar cost average into an uptrend. This right now is not when you buy the dip. We're not dollar cost averaging into an uptrend anymore. You're attempting to call the bottom. So that's a very clear and very important distinction to make, is when you're in a downtrend like this, you're attempting to pick the bottom. When you're in an uptrend like this and you try to short, you're attempting to pick the top. But you are trading against the predominant trend. If the red line is above the yellow line, the trend is up. If the yellow line is above the red line, the trend is down. So as of only a few days ago, we confirmed a downtrend for the first time since way back here. And before that, the first time was way back here. So is now a good time to be dollar cost averaging in? Or does it look like this is what's happening right now? Does it look like we just got this move right here and then we crossed over and now we're finding temporary support? Does it look like we're going to come back up, try to get above the 8, and if we do, retest the 21? And if we get rejected, does it look like we're going to take a massive hit to the face? Does it look like this asset is going to die? Does it look like the markets are going to capitulate? Man, I mean, I don't know what you guys are seeing, but sure looks like it to me. So what we're expecting to happen here is consolidate long enough that this red moving average comes over here and starts to level out. We'll test it, and if we can get back above it, our next target will be the yellow, the 21. And by then it will have leveled out around this range, and we could potentially get that move back up to like 10,000, 11,000. We could even get a retest all the way back up to the neckline to psych people out and think we're getting continuation to the upside, and then bam, rejection, massive sell-off. But if we do flip the trend back over, can we continue to the upside? And this was just a bullish retracement up the bearish dump? Yep, 100%. And that's why we stay dynamic in these markets. And that's why moving average crosses like this are so fucking basic. But if you just keep it simple, you will make money in these markets. You will make money in any trending asset you ever trade if you literally just trade this system. Because even if you lost a bit right here because you got psyched out because it didn't keep going to the downside and you bought back in, even if this came in and the cross was higher and you bought back and you got less Bitcoin, who cares? Who cares? Because you didn't lose, because you literally de-risked this danger zone. Because this doesn't look bad, and this happens occasionally, but the majority of the time with these moving averages, this is what happens. This is what happens. This is what happens. This is what happens. So if every once in a while you get burned by a little bit by one of these guys right here, if you zoom out on the chart and you look at that, who cares? That's nothing. That is absolutely nothing. So I'm going to take a quick break here, not from the charts, but just give you guys an opportunity to ask any questions or anything like that that you do have. Both those are actually EMAs, exponentials. The only simple moving averages that I use are the 55 simple and the 200 simple. And the only reason I use those is just because of traditional markets. Essentially, like, crypto markets are full of two things. People from traditional markets that are already great traders that love the volatility of crypto, or just people that are just new to markets completely, that basically, just believe in it because of like fundamentals. But 95% of crypto is made up of those two things. Very experienced traditional market traders and complete newbies that believe in Bitcoin and crypto. And there's nothing wrong with being either one of those two things. But if you're going to trade in these markets, in my opinion, it's very, very important that you pay attention to the simple moving averages, in the same way that like all these Wall Street guys that switch over to crypto, they take forever to realize that exponential moving averages are where it's at, and they take forever to realize that log scale is where it's at. And the reason those two things are so important is because of the increased volatility. When you're looking at like traditional markets and they're having like 6% moves in a year, like that's fine. You don't need to use log scale. You can use price as your movement, not percentage. That's completely fine. And you can use simple moving averages because it doesn't matter anymore what happened recently as what happened like way back here. But if you're using, like if you're having massive moves like this, like hundreds of percents or like 30%, like double digit, triple digit percentages, you need to use exponential moving averages. You need to use log scale because the moves are so big that if you look at these charts, that's not bad when you look at it right now in regular scale. It looks pretty normal. You know, it's like, okay, that's fine. Why, I don't see why you couldn't use that. And the difference being that these increments on the side don't change. It goes from 6,400, 6,800, 7,200, 7,600, 8,000. It's literally just going every $400. But if you switch to log scale now, you'll notice these numbers are different. It goes 50, 40, 53, 20, 56, 59, 62, 65, 69. So it's essentially increasing as we get higher. And it's because it's using percentages to draw this chart now instead of dollars. And when you switch over to a long time frame, that's when you see the real difference, because this is log scale and this is a readable, useful chart. This is regular scale. What the fuck are you going to do with that? None of this, you can't even see anything right here. It makes no difference. It's useless. This looks ridiculous. It's so intense you can't even use it. And then like this shit is just same thing. But if you switch over, that's a much more usable chart. That's much more useful. So that's the importance. Like the longer time frames are exponentially more important to use log scale. But again, it's still, in my opinion, much better to just always use log scale. If you want to keep one chart that you keep in regular scale and you flip back and forth to, by all means, that's great. But it's the same way with the moving averages too. If you're using an exponential versus simple on a longer time frame, it's much more useful if you're in log scale using exponentials than if you're in traditional using just regular SMAs. So, other questions? Yeah, I pretty much keep everything on log scale. It's just so much more useful because of the percentage moves. And that's all it is. It's just literally drawing your chart and doing all your moves and everything based on percentages rather than based on dollar value.
Yeah, because I did have a look last night at it, and you do get slight fluctuations where the moving averages and some of the supports are. So do you find it's kind of works in the log scale?
Yeah, I mean it's much better. I mean you may have literally like that's the reason I use like those two moving averages, and everything else is in exponentials. And I can show you a specific example right here real quick. This is on longer time frames. It's not as relevant like this when you're on like the daily, but you can see basically like there's always going to be times, and now granted these are not exactly the same. One is 50 and one is 55, but you'll see there's like specific times where one will correspond much more. Like we didn't make it to the 55 right here. The 50 though, the bright green one was acting as resistance. Same thing right here. We got slightly above it, but it's acting as resistance. So like in this case, you're not seeing much correspondence out of the 55. But there's also going to be times when the 55 picks it up perfectly. Typically it's on shorter time frames. Like here's a specific example right here. Like the 50 we broke right through, no problem, but the 55 rejected us. So if you weren't looking at the 55 and you were only looking at the 50, it would look like we were above it and we were consolidating and we were going to move up. But if you were looking at the 55, it's the opposite. We broke up to it and got rejected by it twice in a row with this pincher top, and then basically rejected down through it. Same thing again right here. If you're looking at just the 50, exponential, the bright green one, you're thinking, okay, we're consolidating at it. We're going to break through and continue to the upside. But then if you're looking at the 55, that's a perfect point to short or, no, okay, we got rejected for a reason. Because if you don't have this 55 on here right now, it's... Every time we break above this, you're going to think, oh, that's it, we're consolidating, we're going to move up. Oh, we're breaking above it, we're consolidating, we're going to move up. But, obviously you get rejected massively, like twice. And the 200's even more clear. Uh, 200's even more clear how it corresponds sometimes. Like, look at this price action right here on the 4 hour. You find support here. If you were only looking at the 200 simple, we broke down below it right here. You're thinking, okay, we're about to get wrecked. It's like essentially like the opposite of a blue sky breakout. There's no support left. We're going to sell off. But if you're looking at both right here, you realize the exponential saved us. So even though the simple right here, we fell below it, the exponential saved us. We were never in danger. And then here, it's acting as resistance, acting as support, break through it, acting as support, come back down, look like we're about to lose it, but then we get picked back up, acting as resistance, acting as support, and then again, acting as support right here. If you were only looking at this one, once we lost it, you think we're just going to dump to nothing, and then here we consolidate below it, it's acting as resistance. But if you're not using the exponential, think about what your chart's going to look like. So this is what Wall Street guys were seeing, because they use only the 200 simple. They're thinking, oh, okay, this isn't really helping right now. I don't know what's happening. As where we are using both of them, and we have a massive advantage. I mean, look at that advantage we have, because we see what's actually happening right here. We're getting rejected by the exponential. They are just wondering what's happening right now, because what even saved this? What even saved this? What's happening right here? Are we getting rejected? Are we going to move back up? But we're seeing that whole picture, and that's what it's all about. That's why I use both. It's all about the big picture. What else we got, guys? Did I answer your question okay about simples and exponentials and why I use them? Do you understand the difference also? Does everybody know the difference?
It's familiar.
Just in case somebody doesn't know, I'm just going to give you a brief explanation. The difference is like when we look at the 8 moving average in red right here, exponential, what it's doing is it's looking back the last 8 periods. So it's going 1, 2, 3, 4, 5, 6, 7, 8. It's taking these 8 candles. It's taking the price on each one of these candles at close. It's multiplying it by the period moving average, which is 8. And then it's dividing it by the total amount. And then that's where the moving average comes in at. But in an exponential moving average, in a simple, that's the whole formula. It's the 8 periods times the price close at each of those periods divided by 8. And then that number is where it prints the moving average at. And then with an exponential, it does the exact same thing, but it has a weighted multiplier, which means that this candle's weight is much more important than this candle's weight. So if you say this one counts as 1.5 times as important, this one counts as only 0.5 of importance. And then somewhere in the middle is like your 1-to-1 ratio, and then each candle in between is either exponentially more or less important. And if you did the same thing for the 21, the only difference is it's just going 1, 2, 3, 4, 5, 6, and counting back the last 21 candles. So that's why it's so much more important to use exponentials in crypto, because 21 candles is important to look at. It's important to look at these, but the most important shit to look at is what's happened recently, because there's such violent moves in crypto. So everybody got this pretty good. Everybody pretty much understanding why we use exponentials, why we use simples, why we use specific moving averages we do, how you can use the 8 and the 21 moving average cross, especially on longer time frames, to be the most important. All right, sweet. So while we're on the 4 hour now, you will notice that we still have our circles drawn from the daily. And those are overall telling us the predominant trend. But now inside of that trend, we're going to see a little something different because we're on a shorter time frame. we're going to see right here, we actually confirmed a cross on the 4 hour. So that was a cross down, that was a cross up, that was a cross down, that was a cross up. So while this is much more dynamic, it's also much more choppy, because you might have entered and exited at a loss multiple times through here, but it also will get you in and out of trades a lot quicker, because as where this move had to happen before it crossed over on the daily, if you were watching the 4 hour, you would have been in this trade already right here at 91.50, as where if you look at this on the daily, you wouldn't have been in that trade till 93.20. So it's going to give you more signals. It's going to be a little more dynamic. It's going to tell you a little sooner about a move before it happens, but it's also got a lot more chop. It's got a lot more opportunities where you could get yourself into trouble. Would it have been nicer to sell on the 4 hour and short the cross right here? Yes. Would you have potentially bought right here and then sold right here and then bought right here and then sold right here? Yes. So the shorter time frame moving average cross is going to be just as useful, but it's going to be less useful in the predominant overall trend of the market. So it's more dynamic, but it's less consistent. So when you're beginning, it's important to use longer time frames with less entries and exits, because you're going to have a higher hit rate. But at some point in time, is this going to cross back over and potentially you could enter a trade on a 4 hour that's going to get you much more profits because you enter sooner? 100% for sure. All right, so I'm going to switch back over to the daily, and I'm going to pop just a couple more moving averages back on. We sort of just already went through this, but so you basically see now that what these are doing is, once we start moving to the downside and we have all the moving averages below us, they're acting as like a stairway. They're stair steps for price action. So the first time we sell off and break through and get that cross of the 8 and the 21, our next stair is going to be the 50 or the 55. In this case, we just got that massive dump, but that was just like a huge stop run of basically just people getting decimated because the whole entire market was so convinced we were going up, and we were literally the only people in. I mean, I don't know that I saw anyone ever with the head and shoulders pattern, which was the most clear head and shoulders I've ever seen in my life. I mean, but I'm not on as much social media as people, but as far as I'm concerned, we were the only one who saw this happening. So when this happened right here, I mean, as far as I'm concerned, everybody took that to the face. If you weren't part of our group, if you weren't part of this channel, you got wrecked. And, you know, you see all these smiles on people's faces when they're talking about, in hindsight, this happening right here and how their dollar cost averaging in and how these moves happen. If you believe for 1 second that there's a single person in all of existence that didn't mind that 10 or 11% drop on Bitcoin, that didn't mind just taking this straight to their face, you think there's one person in all of existence that was too lazy to exit a trade to save 10 to 20% of their account? I mean, come on. These people are idiots and liars. Nobody wants to ever lose 10% of anything. I don't care what it is. Unless it's your freaking toenails and you just trimmed them. That's the only time you want to lose 10% of something. You don't want to lose 10% of your account. That's ridiculous. So anybody that says they saw this coming and didn't exit trades, didn't distribute all through this range right here, is a liar, an idiot, or delusional. So that's why it's so important to actually pay attention to who you listen to. Listen to people that don't know what they're talking about. I love watching other influencers. I love watching other people's videos and stuff. But just watch them with a grain of salt and understand that nobody ever wants to miss out on this the same way that nobody ever wants to miss out on this. So once we start stair-stepping down here, you know, once we come through the 50s, we expect some kind of reaction from the 89s. In this case, we broke straight through the next three moving averages. It was such a violent move. And then we actually moved back up. And now we're getting rejected on the 89. And, you know, that was a lot of the reason why we took that short on Ethereum, is everybody was saying we're finding support. But to me, it's the opposite. We're finding resistance. We were not able to get back up here, and that's why we shorted Bitcoin and Ethereum again. And then again, in the same way that we're essentially finding support on this flat bottom previous tops over here, you know, are we finding support really though, or are we just consolidating before the next dump? Because that's what it looks like to me. It looks like we're consolidating before the next dump. So could we push back up here and unload our positions at a higher area because exchanges or whales or market makers were wrong and don't want to just take the L right here and continue down? 100%. And that's why these markets are always breathing in, breathing out, breathing in, breathing out, breathing in, breathing out, breathing in, and getting the wind knocked out of them. So could we take another breath right here before we blow out all our oxygen again? 100%. But does it look like we're going to start breathing back into the upside? No. Not to anyone that knows anything about anything. And if we do start looking like we're going to trend back to the upside, how are we going to know? We're going to get one of these. We're going to get one of these. And it's not going to happen up here. It's not going to happen back up here. It's going to happen down here. So if we took that exit and we take another entrance on the daily, you're going to be in profit 95% of the time. So if you don't like 95% odds, I don't know what to tell you. You got a better batting average than I do. So any more questions about moving averages, support, resistance, any of that stuff? And you can see also, like on shorter time frames, these moving averages, as we use the different ones, are going to become more dynamic. But you'll notice that the reason I use these specific moving averages, these Fibonacci numbers, is if you start breaking down a day by how many hours are in a day, if you start breaking down a week by how many days are in a week, if you start breaking down a month by how many weeks are in a month, how many days are in a month, how many hours are in a month, it's going to correspond specifically with these Fibonacci numbers. And that's why Fibonacci is so important. It's essentially using mathematical equations to determine like exponential movements in price or in whatever it is you're looking at in science. So in the same way that this 377 on the the 528 on the 4 hour is acting as our rejection point, that corresponds specifically to the daily 89. So the 4 hour 528 is the same as the daily 89. You know, within reason. Not exactly, but within reason. And you will notice that every single one of these moving averages specifically uses that Fibonacci equation, well, except for the 50 and the 200, but very close. They essentially uses that same Fibonacci equation, and that's why I use them. And anybody else that uses them that can't explain that to you uses them because they copied them from someone else and they don't understand it. They just know it works. So that's the difference, and a lot of times you will see between what I do on this channel and what other people do. I'm not saying that other people cannot successfully use the same tools that I use. They 100% can. What I'm saying is that I understand them because I created this system myself, and that I can explain them in a coherent and, you know, basic way to essentially like a child. If a child wanted to understand these, you know, moving averages and why we use them, I feel like I can explain it to someone who knows absolutely. And when I say a child, I don't mean like a 5-year-old necessarily. I mean someone that doesn't understand anything about trading, anything about moving averages, anything about, you know, you have essentially like a base level of understanding of numbers, whatever. So, and that is why it's so important that you're getting your information from someone who actually knows what they're talking about, not just someone who has seen something work and doesn't understand why it works, but they know it does. And that's what this channel is all about, is explaining to you not only why things work or showing you that things do work, but being able to explain to you why they work. And now you could literally go to your friend, you could go to your family member, you could probably, depending what kind of dog you have, if you have a smart enough dog, you could probably explain to your dog why some of this stuff works. But to somebody else, it's just copying a chart from someone else, or just stealing information, or just sees something work and then just copies it. They're not going to be able to explain this shit to you. They're going to be able to tell you it works. They're going to be able to even show you it works, but they're not going to be able to explain it to you. So the most important thing for me is not just to show you how I throw a lure into the water with a worm on it and a fish bites it and then we catch that fish and we eat it. I want to show you where we get the worms. I want to show you how we stab them on the hook to make sure the fish doesn't just come and steal it. I want to show you how to make sure we set the hook correctly, how to reel that fish in. I I want to show you how to determine if we're going to keep that fish, if it's safe to eat, how to skin it, how to fillet it, how to cook it. I want to explain to you every single step in a very useful way that not only can you now go out and catch your own fish and be self-sufficient, but you now are a Jedi Master in time, and you can teach somebody else how to use the Force. You can show somebody else how to use a lightsaber, and you can fight good and evil, depending on which side of the dime you decide you want to be on. But that's what this is all about. Like, not to quote like the Bible or whatever, but, I'm out here to teach you guys how to fish, and then you can go out into this world and share your knowledge and help other people use that knowledge to become better people, help their families the same way that I want to help you help your families, because I can't just trade these markets. I have limited time. I have limited assets. I cannot just feed everyone's family. But I know that if I teach enough people how to do what I'm doing, it's not going to hurt me in one bit. If anything, it helps me. Anybody that's been in the group for more than a couple days will notice that there are specific times when other people have shared charts, shared assets, shared whatever, and I may have said, holy shit, I didn't notice that because I don't look at Tron. I didn't notice that because I'm not looking at X coin, Y coin. I'm not looking at a 1 hour chart. It does not mean that you cannot successfully trade on a 1 hour chart. It does not mean that you cannot make massive gains on a piece of shit scam coin like Tron. It does not mean any of that stuff. It just means that I have limited amount of time. I have limited amount of assets. I have limited amount of, basically effort that I can put in any of this. So I use that in the most efficient way possible to get the most effective way, results I can. But it doesn't mean that I don't want you guys coming at me with your charts or your shit coins or whatever, because I don't care what we're trading. I don't care what it is. If I'm investing in something, I care about fundamentals. That's why I like gold and silver and shit like that. That's why I like the stock market normally over time. That's why normally I like, buying Bitcoin over time for long swing positions. But I'm not going to hold some shit coin for long periods of time. And as a matter of fact, this is a good time for me to talk about, one way that I accumulate, actually. If you're new to the group, you may not understand that I have essentially multiple accounts. And I use a scalp account for short-term moves, like trades like this or trades on a 4 hour. I have, this is like what I would call a swing trade right here, where you're basically in it for months at a time in a long trending market. And then I have essentially investments, which are what I call purchasing things with no interest of selling them, or only selling them after years of holding them. I don't invest in crypto. I have some Bitcoin that I hold indefinitely or for massive moves, but when we got to 20K, I dumped everything. I didn't hold any crypto. I did not take any of that downward motion. I have no interest in that because that was a long-term trend after a parabolic move, and it was exhausted. I have investments in things like property, homes, gold, silver. Those are things I invest in because they're proven over time. They're the type of thing that if you end up in a position for 10 years or 20 years for a downtrend, it's still useful and it's still beneficial. You might have got stuck in gold for 10 years or whatever, and yeah, it sucks because gold's not moving and that asset is tied up, but it does not cost you anything to hold gold over time. You can literally put it in a plastic bag, dig a hole in your yard and bury it, and it doesn't cost shit. And when you dig it up 30 years later, what's it look like? A bar of gold. And what's it worth? The same or better. By the time you take into account inflation and all that shit and everything, maybe you didn't make money, but it was a legitimate store of value. A piece of property is a store of value. A home, if you live in it, is a store of value. It's something that's a necessity. You need to live somewhere. So if you invest in a home, that's great. But if you invest in a $10 million home and you bought it at $10 million and it goes down to $2 million, that's not an investment. Okay, because there's upkeep on a home. It costs money to keep the electric on. It costs money to keep, the heat going. It costs money to keep the yard tended. It costs money to keep termites from eating it to pieces. It costs money. All that shit has upkeep associated with it. So a home is different in the way that the upkeep is still beneficial because you need somewhere to live. So it's not a big deal if you have to pay somebody to mow your lawn, or you have to enslave your children and have them do it for you, or you have to go out there and do it yourself. Like, that's okay. That's fine. You know, because you're getting a useful like function out of it. A car is not an investment though. If you're buying an old limited edition car like a Shelby Cobra from the 60s, yeah, that's a fucking investment because they're not making any more of them. And it might have some upkeep, but over time the upkeep is substantially less than the value of that asset will be. But if you're going out and buying, you know, a 2020 car right now, I'm going to tell you right now, you drive it off the lot, everybody knows what happens to the value. You pay $100,000 for it, you go to trade it in the next day, and they will give you $60,000 for it. And you say, I only put 9 miles on it and decided I didn't like it. Why is it worth 30% less? And they say, well, we sold it to you and it was new. And you go, well, it's still new. And you go, nah, your name's on the title now, so it's not new. That is depreciation. And that is what most quote-unquote assets do over time. And that is why silver and gold and even shit like copper, palladium, platinum, all those things are exponentially more valuable as a store of wealth. Because no matter what happens, there will almost never be a situation where you lose money on that asset over a long period of time. As where a house could burn down, you know, a piece of property could go to shit because, you know, they built a highway next to it and nobody wants a highway right next to their house unless they're going to build a gas station there. It's less useful now. So the idea is that with gold and silver and precious metals and stuff, yes, they might on paper look like they're worth less because of fluctuations in the market. But if you take into account what like your dollar or your currency that you use to buy those assets with, it's going to always be relative because the amount of money and effort it took to pull gold out of the ground 100 years ago is still relative to what it's able to buy now based on the amount of money and effort it takes to pull that same gold out of the ground. So back then you could take a piece of gold and it was worth $50 and you know you could buy a car with it. Now you take a piece of gold and it's worth $2,000 and you can buy a shitty Honda Civic, you know, from 1995 or whatever. But essentially it has, you know, it's a store of value. It's not necessarily going to be worth more money, more currency, but it has the same value essentially as it did before. And yes, you will see fluctuations like gold and silver right now are essentially like priced below what their actual value probably is based on historic time. Like if you look at, you know, what could you buy with a piece of gold 1,000 years ago? What could you buy with a piece of silver 1,000 years ago? And then what was the relationship between gold and silver over time? Like we had fluctuations recently where silver was worth 1/120th of an ounce of gold. So it took 120 ounces of silver to equal 1 ounce of gold. As where if you look at biblical terms, you know, thousands of years ago, if you look at Roman times, if you look at, you know, hundreds of years ago, like documented times, the historic difference, the historic ratio between gold and silver is closer to 10 ounces of silver to 1 ounce of gold, or 20 or even 50 ounces of silver to 1 ounce of gold. So why do I like to invest in silver right now and over the last few years? Because essentially at some point in time, that ratio between silver and gold is going to go back to its historic value. It's going to go back to like 50 to 1. And if silver goes 50 to 1 on gold and gold doesn't move, a 2,000 ounce piece of gold is going to be, what is that? $400 piece of silver? No, is that 200? I don't know. Yeah. So essentially, like if it goes to 10 to 1, you know, and gold's at $2,000, silver is going to be at $200 an ounce. If it goes to 40 to 1, it's going to be at $50 an ounce. Like there's a lot of, you know, fluctuation. If it goes to basically like what people are expecting, which is 50 to 1 odds, you're going to see basically silver at $40 an ounce if gold doesn't move. So if gold goes to like $5,000 or $10,000, that means silver is going to be at like hundreds of dollars an ounce. So while people right now say, I don't know if I want to buy silver because it's $28 an ounce and the exchanges and the pawn shops want an extra $3 an ounce, which is 10%, and that's too big of a loss for me. Well, is it though? Or is all of a sudden they're charging a massive premium because the people who know what they're doing realize that very soon it's going to be worth $40 an ounce, $50 an ounce, $200 an ounce. If you ask me, that's what's going to happen in the very near future as all these currencies like crash and go to like very low values. So I know I kind of went on a tangent there, but that's an important thing for people to understand, and it's an important thing that people were discussing recently in the group. Right now, if you're not already invested in gold and silver, I bought a ton of gold and silver at like $1,300 an ounce for gold, and like my dollar cost average into silver was like $14.50 to $15.50 basically. So I've basically already done like 60 to 100% moves on those assets. And I mean, I was telling everybody to buy back then. And you know what people were telling me is, gold's shit. It's been doing nothing for 10 years. Silver shit. It's been doing nothing for 10 years. Well, what are those same people doing now? And why are physical hard assets going parabolic right now? That's not normal. Physical hard assets don't go parabolic unless there's something big going on behind the scenes. And, you know, essentially what that means is like the crash. And the crash has been like, you know, foretold for some time now. I mean, if you haven't been following the channel, you know, I was literally talking about the crash in the stock market at the end of last year. Like between August and December, I was warning everyone, hey, check it out. That's when I started my channel. Stock market's getting ready to crash, and here are reasons why, and here are targets and price targets and where it's going to go. And we literally hit those price targets within the bottom of the S&P and the Dow Jones. We hit to my target within 0.5%, 0.5% away from my exact targets. So this is not just luck. It's not a magic 8-ball. You know, it's a combination of basically all these different things. So when you can start to put together the big picture, you can understand what's happening. So when I tell people, you know, my opinion right now, not financial advice, is, hey, it might not be a bad idea to start stacking a little bit of gold and stacking a little bit of silver and, you know, putting them in a safe somewhere or under your bed or whatever. There's a reason I'm saying that. And there's also a reason I'm telling people that I have the largest cash position I have ever had in my life right now, and the least amount invested in things like the stock market and cryptocurrency. It's not because I think cash is going up. It's not because I think cash is great. It's because the most important thing in the very near future is going to be liquidity and solvency. Because at some point in time, you're going to go to sell your shit, and nobody's going to want it. Nobody's going to want your third car that you have, because everybody's going to be selling their third car and their second car because all of a sudden they're not working, or their wife's not working, or their kids aren't going to school, or whatever the reason is that before they needed all this extra shit, spare houses, spare cars, spare whatever it is, you know, they're not going to need that anymore. And you're not going to need yours, and everybody else is not going to need theirs. So all of a sudden you're going to go on Craigslist and you're going to say, holy shit, look at all these deals on literally everything. Why is everything so cheap? Because you can't eat an Xbox. You can't eat a car. You can't pay your mortgage, you know, with your workout equipment. So everybody's going to start dumping all this stuff on the markets. So while everybody was spending up all their stimulus checks and everything when they first got them and wasting it on dumb shit, you know, and the economy was still pumping and stocks were still pumping, very soon it's going to be the opposite. All this shit is going to be near valueless because nobody's going to want to buy it. So yeah, you could say Kelly Blue Book on your car is $20,000, and then you go on Craigslist and you could buy that car for $8,000. Well, I'm not going to sell it for $8,000. Kelly Blue Book says it's worth 20. Well, is it worth 20, or is it worth somebody's willing to pay you for it? Because in all reality, that's what a free market is. A free market means, what is somebody willing to pay you for whatever you're trying to sell? What are you willing to pay somebody else for whatever they're trying to sell? So you can take all the books in the world and all the charts in the world and say this is what it's worth, and that's its value. But its real actual value is what someone will pay you for it. And that's what's very, very important, and people are not realizing. For a long time, things have been valued over what they're worth. Their price has been higher than their value. And very soon it's going to be the opposite. And it's going to be like that for 3 years or 10 years or 30 years, depending how bad all these governments fuck everything up. So let's take a little break again, too. If anybody wants to ask questions for the next 5 minutes or whatever, that's fine. If anybody needs to get up and use the restroom, get a drink, grab another piece of paper or whatever you want to do, that's fine as well. So. Oh, when we got the massive dump, I was already expecting all that, man. Because of the stock market, I had predicted basically, in March? Yeah, that was the big dump, right? Is that what you're talking about? The capitulation in crypto and stock market? Yeah, I mean, here's the thing. Okay, people want to act like these assets aren't correlated and everything, but let's be real. There's only so much money in the world, and it can only go so many places. So all these things are going to be correlated. So, I was telling basically family members, friends, anybody that would listen, trying to help them basically understand that yes, we could see a little more price action to the upside, but that we were closer to the top than the bottom, and it was time to de-risk. People don't want to listen because things are going parabolic. You think it's going to go to the moon, but that's not how things work. Like you get the most bullish at the top and the most bearish at the bottom. That's literally the whole point of human nature and psychology and why this is all so important. So for me, I was already very, very much de-risked. I had still like some assets, but I was very, very close to out. And then like leading up to the actual like big dump and everything, I was short in a lot of stuff. So I was able to capture a massive amount of all that movement. So, but look exactly what we saw on the chart right here. Okay. Look, daily in, daily out. So you could use your moving averages and nothing else. You could have absolutely no knowledge of anything else that I knew about that was going on in the economy, that was going on with CV, that was going on with all that stuff. Now, granted, I had like a massive amount of inside information because I have direct contacts like with China at the time. I have basically like friends in all different industries and markets that basically had, I don't want to call it insider information, but it's essentially information that the masses don't know about. So I knew what was going on in China. I knew what was happening. I knew how bad everything was going to get, or at least how bad it was potentially going to get, and how little we understood about what was about to happen to the economy, and also like, with CV and all that stuff. So, I mean, you could say like, that was a huge part of it, and that's what it was able to give me like confluence in so many different ways. But the truth is, what did you really need? Two moving averages, an 8 and a 21, and a daily chart. You know what I mean? That was all it took. And it was very clear when we came down here and the 200 saved us, but we were just slowly creeping. We got that dead cat bounce and we couldn't get back above the 8 here. And then what happens when you get above the 8? You come back and test a 21 every time. That's what we're looking for right now in Bitcoin. As soon as we get a close above the 8 on the 4 hour, we're expecting a push right up to the 21. And then what's going to happen then? Rejection. And then that was it. I mean, you already knew. And again, the 377 didn't act as support right here. We sold straight through it, but act as resistance very clearly. And then what was acting as support? The 528. I have literally never in existence in all time, in all the years I have traded, done technical analysis, looked at assets, looked at charts, looked at people's stuff from 100 years ago, looked at Charles Dow theory, read books. I have never in all of existence ever heard of anyone ever using the 528 moving average. I literally made that up, and I don't think there's anyone in the world that can argue that. And where did it come from? Fibonacci sequence. It's fib number. That's it. So, I mean, this stuff is literally proven before you even come up with it. And we could come up with another one that would be way down here. But it's just how relevant is it ever going to be? You know what I mean? But, I mean, yeah, you don't need every single bit of knowledge. Like, the more confluence and the more things that you have telling you this stuff is great. But in all reality, that's all you needed. That's all you needed. You know what I mean? That's all you needed. That's all you needed.
Yeah, this is what I'm learning. Basically, to try and keep it as simple as possible.
Yeah, that's that old saying or whatever. KISS, K-I-S-S. Keep it simple, stupid. Like, start with the basics and then build on top of those basics. But you're finding something that already works. Moving averages. The 8 and the 21 already work. Now you want to add in a 50, you want to add in the 55, you want to add in the 89, you want to add in the 200, you want to add the 377, the 528. That's fucking awesome. By all means, do it. Let's go. You want to add in horizontal support, you want to add in resistance, you want to add in diagonals, you want to add in indicator oscillators, you want to add in all that stuff. Fuck yeah, let's go. The more things telling you the same thing, the better. Or if you have one thing that's telling you, hang on, man, everything's saying bullish, but this one thing is saying bearish, maybe I should be paying attention to that. Because that's like, divergence basically between things, as where you have multiple things like giving you confluence. You have one thing saying, I don't know, man, I disagree. And we used this example before. If you have a pilot and a co-pilot in a plane, you have two guys flying a plane, and it's clear skies, and they both say, clear skies, looks good to me, bro, let's go. And then you have a storm comes in, and one guy goes, hey, man, been in way worse situations than this, not worried at all. And the other guy goes, hey, man, I was on a plane one time, and we got struck by lightning flying through a storm, and we crashed, and took 3 months to get rescued. We were in the middle of the Alps, and a bunch of people had to eat each other. So maybe we should be careful and fly around it or above it or land the plane. Like, that's what you have basically going on in markets. You have two pilots telling you the same thing. You got the 8 and the 21 telling you the same thing. And then when they cross, they're telling you, hang on, man. 200's still saying we're bullish. We're above the 200 moving average. We're bullish. That's a guy in the back seat saying, man, I ain't worried. But maybe he had a couple Heinekens, so he's just not scared. Maybe he doesn't know what he's talking about. But, you have starting to see now things are disagreeing. And now if you take that same plane, and you have a pilot convention, so you have a pilot and a co-pilot, and then you have 20 pilot passengers in the back, and 19 of them agree, hey, this ain't shit, we're good to fly through it, whatever, might be a little turbulence. But one guy is telling you, well, I actually crashed in turbulence one time because we were at too high altitude and it snuffed out the flame, and one of the engines went out and we lost power and crashed. Like, the likelihood of that happening might not be high, but it's important to keep that in the back of your head, because as you start getting more and more things telling you that they agree or disagree, it's more important to pay attention to that stuff. And that's what we use all these different things for, all these moving averages, all these indicators, all these oscillators. Because like right now, the 8 and the 21 are saying, hang on, man, we might be selling off. But as long as we keep finding support on the 200s, the 377, the 528, we're still technically in an uptrend, because we're not going to come down here and take out this low without taking out these moving averages. In order to take out this low, we have to break below this moving average. So that's what we look at all these for. So when they start coiling down and we end up below them, that's when you're like, hang on, we might be selling off big here. And that's what these analogies are all about, and these indicators and oscillators and everything are all about, is you can trade just off of the 8 and the 21, and you will have an extremely high success rate. But if you're starting to be able to use the 200s to find where you can find support, so you can re-enter a trade on the 200 and you don't have to wait for this cross, you can get back in at a better price. Like, you could get back in down here maybe instead of up here. You're just going to have better trades, but you're going to be more consistent if you just use the basic one that you know works. But if you can start increasing your hit rate based on adding in other little things, other little simple stuff like that, that make you either not get in a trade at all, get in a trade sooner that was going to be a winner either way, get out of a trade sooner that was going to be a loser either way, like, that's just going to help you overall have a better system, higher success rate, higher profit margin, all that stuff. But the truth is, you don't have to know anything but the 8 and the 21. And in a trending market, you will succeed over time, always. About an hour. Okay, let's keep going and just finish out the this indicator, the parabolic SAR and the binary pivots, and then we can dive into some of the other stuff later. I don't want to go too long because I know you guys have stuff to do as well. So, and I trade typically on the 4 hour, so I like to have basically at least like 15 or 20 minutes before the 4 hour close, just to check my positions and manage it accordingly and everything. So. Let's finish up on this one, and then we can dive into the other indicators either later today or tomorrow or whatever this week sometime. So, all right, so let's turn back on some of the other stuff here. All right, so I'm going to turn off the moving averages. I'm just going to leave on the 8 and the 21 again, and then I'm going to use the binary pivots. Actually, let's start with the binary pivots, and then we'll do the SAR afterwards. All right, so the way these work, these pivots, essentially, is basically it's very clear when there's not a bunch of other shit on the chart, okay? It's very, very easy to tell now what they do once all the other stuff's out of the way. They're basically just putting in a resistance, resistance, putting in a support. And it just stair steps up as price action moves. And the closer everything gets, the tighter everything gets in the range right here, the more likely we are to see massive volatility. So the same way that these are like tightening up, it's like, imagine if you took like a bouncing ball or whatever, and you like bounce it up and it hits the ground. Somebody's giving me an echo on their mic right now. You hear me? All right, there, it's gone now. So imagine if you like slam a bouncing ball basically at the ground. It's going to bounce off the ground and hit the ceiling, and then bounce off the ground and then hit the ceiling, and it's going to keep just bouncing through here. But if the ceiling is lower or the floor is higher, when you throw that same ball, it's going to bounce faster and more intensely. And then eventually what's going to happen, it's like that game Super Breakout. It's going to run out of blocks to bounce off of, and then bam, it's going to shoot up violently. Same way back here. Tightening, 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 and then it's falling out, and then eventually there's nothing left holding price up, so it just falls into nothingness. But then when it falls into nothingness, it gets a big bounce, another bounce, another bounce, another bounce, another bounce, another bounce, another bounce, but it's slowly creeping up in the direction of the trend. But these right here are just telling you where the ball is likely to bounce at. And all it does is, once you take out the previous one, it just puts the new one at the top of that one. It just puts the new one at the bottom of the previous one. Okay? So as that happens, essentially, it's just creating a range for us to trade in. So we know when we're at the top of this range, we're likely to max out. We know when we're at the bottom of this range, we're likely to max out. But then eventually, we're going to break that range in one direction or the other. But for all this time, all throughout here, we're inside the range. And then when we finally break out of that range, we can expect continuation. And then we'll keep putting in. But the important thing to notice is which way we are, if we're bullish or bearish. So all this is telling you, when we broke the range here and we're on top of all these moving averages, we would expect the range to continue going to the upside. And then when we top out up here and then we sell off and we start losing these moving averages, we would expect it to go to the downside. So right now, what do I expect to happen? These are going to start getting aggressively dragged down here in the same way that we're going to start like stair stepping down here. And then eventually we're going to create like a flat bottom support like this, trade inside that range, and then we can go back up. But in all actuality, it's the same thing we always talk about. It's the market breathing in, breathing out, breathing in, breathing out, breathing in, breathing out. And eventually you're full up here, you breathe out, you're full up here, and then you breathe out, and then we're going to start exhaling more than we inhale. And that's the trend changing. Here we're inhaling more than we exhale, and then we're going to start like doing stuff like this where we exhale more than we inhale. And that's all we're looking at with these binary pivots. And it's super basic, super simple, but a lot of times it gets lost with all the other colors and everything else going on inside the chart. So does anybody want any more clarification on the pivots or anything like that? If not, I'm going to move on to the parabolic SAR. All right, so now here we have the parabolic SAR, and what this does, essentially, it starts exactly the same. Our top point right here is where that red parabolic SAR is at. That's the high for it. Our low right here is where the green parabolic SAR is at. That's our low for it. So we basically have buys and sells, support and resistance based on the same areas. So you'll notice there the height of where this is at is the same, but with the parabolic SAR, it's going to draw it once the trend flips. But with the pivots, it's going to draw it once we put in that high or that low. So you can see how they correspond when I put them all together. But the idea is that this is telling you what the trend is, okay? So here we're in essentially like consolidation, back in the uptrend, consolidation, back in the uptrend, and then this is downtrending now, consolidation, and then back into an uptrend. Consolidation, back into the uptrend, and then now we're starting a long-term downtrend. And the way you can tell that is, a lot of times you'll flip them over right here. The trend isn't changed, but we're in a consolidation period. But you can typically tell by the amount of these that you get in a row and the way that the price action is moving. If they are moving together like this and you see 4 of them at a similar distance apart, like not going parabolic, not increasing like slope dramatically in one direction or the other, we're basically consolidating. So this is consolidation. This is consolidation, slight trending, consolidation. And then now look what's happening here. It's changing. How does this look different? This is almost a straight line. This is a straight line slightly angled upwards. What is happening right here? This is parabolic. This is a parabolic trend, okay? Because they're not going straight in a line. They're getting not only further from each other in slope, but they're getting further from each other in distance. And what that is doing is it's representing the intensity of the trend. The trend is getting more intense to the upside. So then what's happening here? Consolidation, consolidation, consolidation. Wait a minute. What is this right here? Parabolic. We are going parabolic to the downside right now. We are trending aggressively to the downside right now. That is very important. So that's what the parabolic SAR does. What it does is over time, it not only moves towards the price and creates like a diagonal basically, but it goes parabolic the same way that price action goes parabolic. So it gives you a more accurate representation of what is really happening. So when we put these two things together, you'll notice now what I was talking about. They start at the same spot, but this one is based on the actual trend. This one is just based on the high and low. They start same spot, but it's based on the actual high and low and the trend. So now you have two things telling you within the same thing. One, they're both still support, they're both still resistance, but what is it telling you? It's telling you if one is intensifying, it's telling you where you're realistically going to find support at. Like this is not a coincidence. When this comes up here and then sells off and then finds support at the parabolic SAR, that is not a coincidence that price action came all the way down to it. That is literally market makers selling off. That's whales selling off, trying to reverse this trend and then failing. There was a massive amount. This was supposed to be the end of the trend right here, and it failed. They were not powerful enough to stop the uptrend, so it continued to the upside. In the same way that we sold off right here and we tried to take out this trend, this was supposed to be the end of the trend right there. We took out the parabolic SAR. We started the downtrend, but price action kept going up, and what happened? The bulls attempted to save this trend. Algorithms and bots attempted to save this trend and continue moving to the upside, and it was so weak that it could not even get back up to the parabolic SAR before it got rejected. And once it did, capitulation. And that is why these are so important. But just with an 8 and a 21 moving average and the parabolic SAR and the binary pivots, you should be able to master these markets. You should be able to do essentially better than probably 90% of other people out there. The key is to use all this stuff together and figure out exactly how it works and what it's telling you. And then you can start looking for signatures and patterns and more reliable ways to read it. And, then you can start doing what I do, where it looks like basically you see the moves in the market before they happen. Like, it's not premonitions. I don't have a crazy dream. Like, I talk shit about a magic 8-ball that I shook it and it said the price was going up or whatever. But the truth is, I'm just looking at the same thing that's happened a million times. And, it's like watching a horse race. If you watch a horse race a bunch of times, the first horse, the one that runs out in front of everybody, never wins the race. It's like 1 in 1,000 times that horse wins the race. What horse wins? The one that stays in like second or third place or whatever till the very end, and then all of a sudden bursts out ahead of everybody else. And that's all this is. I just watch more horse races than most people. I just understand the patterns. I understand the way that you win in these markets. And that's what I use. That's all it is to it. It seems like special or whatever, but the truth is once you get a basic understanding of all this stuff, like you could basically leave the group and be a successful trader on your end. Using the assets and the knowledge that I share with everyone, you could probably spend a month in this group and go off and trade on your own. But I'm going to tell you right now, like, for the little amount that you contribute, to the amount of exponential knowledge that you will continue to gain over time and the consistency or whatever, like, if you're not making back exponentially more than you're contributing, you don't have enough money in the markets right now for it to be beneficial to you, because you're not just going to all of a sudden, learn everything I know or whatever, or just say, okay, that's enough. But could you just leave after a month and have enough? For sure. Definitely you could. But I mean, the benefit is exponential because, one false signal like this, get off my, one false signal like this is basically going, to change your whole game. Because here, people sold right here, and then it moved back up, and then they bought, and then maybe they didn't take the sell again, or maybe they took the sell right here and then got wrecked on their position and then didn't take it to the downside. I mean, there's so many different things that can happen. Like, in all reality, like, you know, the benefits of understanding each component of this is exponentially more valuable. But you could get away with just an 8 and a 21 moving average. You could get away with just the parabolic SAR and the binary pivots. You get away with the 200. You get away with all this stuff. We don't even need all the indicators. We don't need all that extra stuff. All it is it's what do they call it? Oh man, I can't think of the term. What is it? It's the icing on the cake. You know what I mean? Like, the cake already tastes good. You could already eat the cake and get nourishments. But when you put that icing on there, it tastes even better. Throw a couple sprinkles on top. You know what I mean? Like, some of those little edible, like, things. That cake starts looking pretty freaking awesome. And that's what this is all about. It's all about building a solid foundation. And then on top of that, we can build an empire of, you know, successful trading strategies, risk reward management, position sizing, entries, exits, consistency. Like, everything is just, it's one more level of icing on the cake. So instead of just eating a regular old chocolate cake or whatever, now we've got, you know, a 20-layer cake with bits of Oreos and Reese's cups and frosting, and there's some ice cream in there, and, you know, we're just taking everything to the next level. And that's what it's all about. But if you start off with a piece of shit cake that doesn't taste good, and you start putting all the icing on it, and you start putting candles on it and all this stuff, and then you go to serve it up to somebody, and they go, well, this ain't a cake, man. This is a rock inside of here. This is pure garbage. Why'd you put a bunch of frosting and sprinkles and candles on a rock and then try to give it to me for my birthday? And that's exactly what people do. You know, they basically get a poor understanding of something, or they start building on top of a shit foundation, and then a storm comes through and wipes everything out, and they blow out their account, and they don't understand why. Well, you didn't take the time to lay the foundation. And that's what all this is all about. All of this is all about a bunch of basic principles that we lay the foundation with, and we build a beautiful, solid slab that's never going to flood, it's never going to crumble, it's going to last for 100 years, no matter what hurricanes come through, no matter what storms, no matter what happens, a big wave comes in and hits the land, it's not going to take out our foundation. So then everything else that we build on top of it is going to last. Because if we don't do it right, if you don't do it correct from the beginning, you're going to end up like one of these guys on YouTube who has a basic understanding of a couple things and then consistently blows out their account, or takes 20% losses, or, you know, somebody like Crown that quits trading but, you know, still acts like they know what they're talking about. You know, once you blow out your account a couple times and you get clipped by the markets, I mean, a lot of these guys never get their balls back. I mean, it happened. Look at like Warren Buffett. I mean, Warren Buffett got clipped by the market a couple times over the last like 20 years, not investing in technology, not investing in the future, not understanding that markets are dynamic. And now look at him. Every decision he's made for the last 20 years is shit. I mean, he has too much money and not enough knowledge, and he's not dynamic enough. Every decision he's made this year has been, he has sold the absolute bottom on the airlines. He bought the absolute top on Apple. I mean, Warren Buffett he's done. He's useless at this point in time. He has lost hundreds of billions of dollars in people's money this year. And he is notably like the best investor of all time. In the same way that people like Peter Schiff, who's been telling you invest in gold for the last 30 years, 20 years, whatever, he has no credibility left. Because everybody that bought gold at $2,000 and then it went down to $1,200 or $800 or whatever, they sold the bottoms. You know what I mean? The same way that they're buying the tops. Like, these people they lose all their credibility over time because they're not dynamic in the markets. And that's what it's all about. You got to stay dynamic in the markets, always be learning, and make sure you have a legitimate foundation. And don't join a cult more than anything. Warren Buffett joined a cult. He joined the what's worked for 50 years, what's worked for 70 years is going to keep working. And a lot of these Wall Street guys are going to get wrecked because of it. And the same way that guys like Peter Schiff and Ray Dalio and these guys are saying like, oh, it's going to crash, it's all going to come to an end, you got to shift, this, that, the other. They joined a cult, the gold cult. That's it. How much money you think Peter Schiff missed out on investing in the stock market over the last 20 years and just buying a bunch of gold? Why not diversify? Why not be dynamic? why not realize that yes, what has been working will likely continue to work until it doesn't, but there's also going to be new things that revolutionize the market. There's going to be new investments that are more profitable. Like, it just makes sense. You know, it makes perfect sense to stay dynamic. And that's exactly what we do. We stay dynamic in these markets. So now that we went over all the different parts of this, broke down entries, exits, all this different stuff, does anybody have any questions specifically about the prophecy or the parabolic SAR with binary pivots? Any part of what we specifically talked about inside of here with the entries, exits, how we should be using any of this stuff? Just this one specific indicator, and then we'll just do one for each of the three main indicators instead of one for all three, because obviously I go on too many tangent rants or whatever. Hey, can you put your mic just a little closer to your mouth again, or just talk a little louder?
Is that a little better now?
Oh, that's 100 times better, brother.
Okay, maybe it's not so much a pivot, it's the SARs. So when we're in the consolidation, I just like to sort of get an understanding of how you get that structure, with the green dots and the red dots as resistance.
Oh yeah.
Does it work?
Okay, let's look at this example right here. Right here, you see this is basically a straight line of green. They're essentially in a straight line. That's a straight line of red. That's a straight line of green. That's a straight line of red. That's a straight line of red. Like, give or take. What is this right here? That's parabolic. That's no longer a straight line. If you drew that same line right here, it would just continue straight. If you drew that same line right here, it would continue straight. This is not a straight line anymore because it's breaking and the dots are getting further apart. You see how the space in between the dots is getting further? That's signaling that you're in a trending move that's likely to continue like parabolic. And that's what's happening right now. This is a straight line. This is a straight line. This is a straight line. But here, something changed. The dots are now further apart. You see the distance between the red dots is getting further. That is signaling that we are entering a parabolic trend, or that we are in a parabolic trend. As we're right here, each of these red dots is the equal distance apart and basically in a straight line. These dots are now becoming further apart. These dots were essentially in a straight line here, but now they're becoming further apart, further apart, further apart, further apart. They start like consolidating here with that dump, further apart, further apart. So that's telling you basically we're in a strong trending move and it's likely to continue until it doesn't. As where this is essentially just a consolidation range. Is that what you were getting at?
Yes, and also, so the dot placement, like when it's going parabolic, like you got the dots are quite far apart from each other. What's placing that dot? What is it? Price? What is it?
Yeah. Everything on the chart is based on candle closes. So essentially what it is there's all this stuff right here, all these indicator oscillators, everything, all the stuff we get down here, all the stuff that shows up right here. All it's doing is it's using like a complex formula and price action. So you take everything off the charts and every single indicator oscillator, every fancy, colorful, piece of shit that we draw on these charts is literally based off of just this candle close action. All these are candle closes. So when this prints right here and it closes and the new candle opens, it puts that dot based on what this candle just said. And then when this candle closes, it prints this dot based on what this candle just did. And then, keeps going. And the same way for the moving averages. As soon as this closes right here and we print our next 4 hour or daily candle rather, this is going to move down here aggressively towards this. But it's going to be based on just what the last candle did. And then when we use our periods, like our time frames, we're on the daily, but say we're using, like in this case, the 9 or the 8 and the 21. It's just looking back at the last 8 candles or the last 21 candles, and then it's using that formula that we use based on that time frame, based on that period, to basically draw these accordingly. So this formula basically draws them straight like that based on the previous high and then slowly will curve down, as will the parabolic SAR draws them based on this, but it uses a parabolic equation to exponentially move. The longer this trend continues, the more exponential you will see it move into. The longer this continues, the more exponential you'll see it move into. So the idea with this is that eventually, no matter what, no matter how many of these we get in a row, eventually price will take it out, because this is exponentially coming faster towards the price. So if price does not continue to sell off, eventually it will flip green and we'll be back in an uptrend. If price does not continue to sell off, eventually the price and the dot meet and then we'll be back in an uptrend. And then same thing here. Eventually we'll sell off and we'll hit that again. Same thing here. These will continue to print more and more aggressively until finally we will hit it and then we'll enter a consolidation or enter an uptrend.
Makes better sense.
All right, who else has questions about any stuff that we covered today, indicator-wise, any of that?
Also, it shows you the higher highs and lower highs and all that sort of thing, which is all the pivots, which is really important.
100%. It's basically creating a trading range. And then we know that if we see something happen like this, where we're in this range and then we break out of it, something's happening. We're either getting ready for a massive move to the upside or this was a massive fake out. But how do you tell? This was already placed in here. That was saying we're at the top of the range. So was it easy to take a short off of this right here? Hell yeah, it was. We already knew that was going to be a very important pivot. You know what I mean? That's why we call it that. You know, binary pivot. It's a place where the market is likely to pivot based on support or resistance. This is likely to be a pivot back to the downside based on resistance. The same way this is likely to be a pivot back to the upside based on support. So this gave us a double bottom, move to the upside. This gave us a double top, move to the downside. But it does not mean that the trend cannot continue to the upside. It does not mean that the trend cannot continue to the downside. It's literally just giving you a pivot, a good place to take an entry. Because look, if we took a short or a long right here off this pivot, we have to have a tiny stop loss to find out we're right. But look at the risk reward. You risk like 2%. If we break through this, we know, it was a break and, that's it. We were wrong and we shouldn't have took a long. It'll take us out of the trade. But what's the move to the upside is massive. The same way right here, we take a short off that same exact spot with like a 2% stop loss. And yeah, something like this could happen where we break through it, hit our stop and then sell back off. But we only had to risk 2% to find out. And if we risk 2% right here, what was that move? You risk 2 to make 8. That's 4 to 1. That's a pretty fucking good odds right there. And that's what it's all about. That's why sometimes I won't post a trade. It doesn't mean that right here I didn't think we were going to sell off. It doesn't mean that I thought we were going to get a massive dump. It doesn't mean I didn't think that it was going to be great. But what it meant was my system tells me that if there's not a good entry point, if there's not a good risk reward that has a high probability of playing out, I'm not going to post that trade for you guys. I'm not going to enter the trade myself, or if I do, I'm going to enter it knowing it's a risky trade, as opposed to when I put a trade that I took in the channel or whatever. It's not financial advice. I'm not your guys' financial advisors or anything, but I'm telling you, look, based on everything I know and everything I see, we have a very, very high likelihood of this playing out. And I think if you went through and looked at the trades or something like that, I think you would probably see that I have not to float my own boat, but I think I have a hit rate of between 75 and 90% on my trades. So, people will tell you that's not possible. Literally, they will say it's not possible. It's 60% is amazing because that means you can win 6 out of 10 coin flips instead of 5 out of 10, and 5 out of 10 you can win with. Well, that's exactly right. You can make money off a 50% hit rate. You can be right half the time, but if you use good risk reward, you will still win. But if you have a high percentage of winning and you win more every time you win than you lose every time you lose, you will literally see massive gains in your account because you are winning more and you're winning more often and you're losing less and you're losing less often. So you can literally go to a casino and play red and black and win. But if you could say play red and black and green, or like you could pick red and then green also, you have a slight edge on the market because there's the same amount of reds, there's the same amount of blacks, but there's also 2 green spots. So that's how the casino makes its money. The casino makes its money on roulette because instead of it being a 50-50 chance, depending if you're playing like European roulette or American roulette, American has 2 green spots, European has only 1. But essentially that's the casino's edge on the market. It's that slight couple percentage of the green, saying that if it's a 50-50 bet and I pay you 50-50 odds, but every once in a while the green hits and wipes you out, that's how the casino makes their money. And that's essentially, you can win like that, obviously, or casinos would go out of business. And it's the same thing with like blackjack and all that shit. I just use specifically roulette because it has a very simple, odds breakdown or whatever. And then if you look at it the same way, risk reward, the idea is that if you and I make a bet every time and we bet on a football team, okay, or soccer team or whatever, I know everybody's like around the world here. If we bet on a sport, I mean, realistically, when 2 teams play each other, there's only 2 teams that can win, right? So either team A wins or team B wins. So the probability is the important thing because it's technically 50% chance if you pick the right team or not. But it's not the same probability as to which team is going to win because one will have higher ratings, one has better players, a better defense, a better offense, a better coach. There's all these other factors. So that's where the odds come in. That's why when you go bet on last year's Super Bowl winners, you're not going to get 1-to-1 odds. When you bet on a fight, a UFC fight or something like that, the guys aren't just, even money. One of them has better odds of winning based on all of these edges on the market. So that's the 2 important things is the edge gives us the likelihood of winning, and then the risk reward gives us the percentage that we win versus lose. So if we take a risk reward trade, it might still have a 50% chance of playing out because it's still a coin toss. What's really going to happen? Price either goes up or price goes down. Or maybe it goes sideways, but eventually price goes up or it goes down. So it's 50-50, right? It goes up or it goes down. You bet on a fighter, you win or you lose. But the actual percentage that you get paid, the amount that you get paid when you win or when you lose is going to be based on the probability of that person, of that team, of that trade playing out. So that's why we're looking for 2-to-1 risk rewards. That's why we're looking for 4-to-1 risk rewards. I can literally look at a chart and say, this is a shit trade and I don't like it, but it has a 4-to-1 risk reward. I'm going to take it because I can take that same trade 4 times in a row and be wrong, and I take it 1 time and I win, and it just wiped out all those. And the idea when it's all said and done is for our small trades, our small wins and our small losses to wipe each other out. And then we want to get out of the big losses. We're not going to take any big losses. We're protecting our capital. And then what is left at the end of that? Okay, we have no small wins, no small losses. They washed out. We got rid of the big losses. The only thing left is big gains. So that's it. So if we get 1 out of 20 coin flips is a big gain, 1 out of 20 coin flips is a big loss, and then 9 of those coin flips are small wins and 9 of those coin flips are small losses, we can let those 18 small wins and losses wash each other out and make no money on them. We avoid the one big loser, and then all we do is look for that big winner. So by taking trades consistently over time and essentially doing that exactly what I just described, we will just win. That's all there is to it. We will win over time. And that's what it's all about. If you build a legitimate strategy and you take your bias out of it and you say, I'm not going to look at fundamentals. I'm not going to be a moon boy. I'm not going to be a doom and gloomer. I'm not going to bet on gold and silver because I'm mad that the stock market's overvalued. If you're going to make your decisions based on actual measurable things and important things and use those basic concepts and basically like a couple other things like position sizing, etc. You don't just go all in on every trade. You're going to win. You're going to win over time. And that's it. That's all there is to it. It's a proven fact. And if it's, if you don't believe it, you can go back and watch every video I put out for the last year and see, I'm not always right, but I'm right more than I am wrong. And based on my yield curve, I can tell you right now that I make more money than I lose. We got like 5 more minutes. Anybody else? Questions? Going once, going twice. Oh, go ahead. Go ahead.
I have a question on the 8 and 21. So let's say we follow these, and if we miss the entry, so what would be the best re-entry on the retest of the 8, of the retest of the 21, or if you could explain a little bit about this?
Oh yeah, I mean, honestly, to tell you the truth, you're not even gonna get the best entry if you just take a hard buy typically on the 8 or the 21 cross like that. You might not get the best entry, but if price breaks down below it, I always would go off of the 21. I would go off of the retest. But again, like here, we break down, it doesn't cross, break down, crosses back over, and then sells off here. This was never actually like a confirmed cross, but once we broke down below this and found support, we would expect it to attempt to save it. In the same way that this, we were about to get the cross and then attempted to save it and it was successful, we would expect on an actual cross the attempt to save it and it's a failure. So you would basically take the retest short from this area. But it's not always going to happen. You might break above it like this and never get a retest of the 21 until what, all the way up here. You could count that. So the best thing to do honestly is, if you miss like the exact entry or whatever, to just start like basically dollar cost averaging into an uptrend. You take the entry off of this area right here, or off of a retest of a horizontal support, or off of some basically any kind of support you could find, or any decent pullback like right here, and then you just assume it's going to be a long trending trade. But this is going to happen sometimes where it sells down, you get the cross, and if you didn't take this perfect entry right here, rejection, you missed that whole move to the downside. It happens though. You're going to miss moves. And then maybe you just take this little guy like we did, and you take that Ethereum short. And it's still great. This was like, I think that was like, I can't remember now. I think it was like 12 or 14% move. And I did like 5x leverage on it. So when it was all said and done, it was like between 60 and 70% of the position. So if you took $1,000 trade right here, you made like $600 or $700 on it. I mean, that's...
Yeah, it was 80% move.
Is that what it was? Yeah. So, I mean, you can't beat that. That's fucking amazing. So you don't have to catch every bit of every move, but essentially this was like letting you know, like, okay, I do not want to be hodling any longer. I do not want to be holding any of this asset any longer. Like, I need to get the fuck out. Even if you take the get the fuck out right here and then it moves back up here, you know that the likelihood of this getting continuation versus this happening right here, maybe you didn't take that exit right here, but we got the cross. But then when it popped back up right here and started showing weakness, then you took the exit. And you actually got a better exit. Same thing right here. You might see this come up here, and then it might come back down all the way to the 89 and stop a bunch of people out. But you might get a better entry, actually, just by missing that. But it doesn't...
Thanks.
Yeah, no problem. The idea is, though, is that essentially the move that follows is going to be like 66% or 75% of the time. It's going to be a massive move like this. Only like 15 to like 20% of the time are you going to get basically like a sideways consolidation continuation like that. And then that's where all the other stuff comes in. And that's where we can start making educated guesses, decisions based on something other than just the 8 and the 21.
Perfect. Thank you very much.
Of course, brother. Anybody else? We got one more question or anything? All right, let's go ahead and wrap it there for today, guys. Appreciate everybody showing up and getting all together for a specific time and making this good. Recorded the video. It's probably going to be a little bit choppy or whatever, but for anybody that missed it, should be able to at least get the gist of it and everything. So I will post that up probably just privately, either in here or on YouTube. And then if you want an invite to view it or whatever, you could either view it in the channel here or potentially I'll put it on YouTube private. I don't think I'm going to let just average Joe have like this kind of stuff. I don't think it's fair that just regular people get all the stuff we do in the private sessions. I want you guys to all feel like you're really getting like a ton out of all this. Because I really do appreciate all the extra support. It takes a lot of my extra time and effort to like run this group and mediate it and have to deal with kicking out losers and moon boys and stuff. And I don't mind it. I actually really enjoy it, and I appreciate what you guys are doing for the channel. I've been getting slowly but surely computer parts showing up, so I'm very close to having the channel's new dedicated rig up and running, hopefully in the next week. But I don't know. I had a couple things that maybe I hang up here. I was supposed to get 2 quantity of some items and only 1 showed up, and some of the shipping quotes look like they may take longer than expected. But bear with me. Very soon we will be on the next level and doing full on like live streams and all that cool stuff. So appreciate you guys. To the new guys, take it all in, take it with a grain of salt. There's tons to learn. I don't expect you all to learn it in a day, a week, a month, but I promise that you will get the value out of this group. So all right guys, appreciate everybody, and we'll see you back in general chat. I'm gonna go ahead and cut it off here. Crypto Trend Trader, and I'm out. Oh, go ahead. What was that?
Just say thanks. Appreciate it.
Oh yeah, for sure, brother. And we'll do the other indicators here real soon too. It's hard for me to like tell how long something's gonna go because I never know when I'm gonna go on like 30-minute tangents and stuff. In my head, it always is gonna be like 15 minutes or an hour, and then in real life, it's like 3 days later. So.